Sir, I think we should start. I'll just start with the introduction. Good evening, all, everyone. Good evening, everyone, and a very warm welcome to all of you from MK Investment Managers family. Thank you for joining us today for another edition of MK Edge series. In this quarterly webinar series, we bring together market insights, expert perspectives, and opinions to help our listeners navigate the ever-changing financial landscape. The start of this financial year has been a fascinating one for equity markets. The April to June quarter began amid heightened uncertainty, with investors closely tracking global geopolitical developments, changing trade dynamics, fluctuating crude oil prices, and evolving expectation around interest rates. These events led to periods of sharp volatility, reminding us once again the markets can react swiftly to global developments. However, what has been equally remarkable is how sentiment evolved over the course of the quarter. As macroeconomics concern gradually eased and confidence returned, Indian equities staged a strong recovery supported by resilient corporate earnings, healthy domestic liquidity, and continued faith in India's long-term growth story. The quarter ultimately reflected not just challenges that market faced, but also the ability to recover whenever supported by strong fundamentals. As we step into the next quarter, investors are naturally asking some important questions. Has this recovery further strengthened the bull case of Indian equities? Are current valuations still reasonable? Which sectors and themes are likely to drive the next leg of growth? To help us answer all these questions, we are privileged to have with us one of the most respected voices in the industry. It is my pleasure to welcome Mr. Manish Sonthalia, CIO and Fund Manager at MK Investment Managers. Manish sir doesn't need any introduction, but yes, I mean, he brings with him over 3 decades of experience in the capital markets and is widely respected in the industry for his disciplined investment approach. He's been with us in MK for 2 years now. Prior to that, he was a part of Motilal Oswal EMC for 20 years, where he served as CIO, managing roughly 20,000 crores of assets. He's currently managing multiple strategies with us. Let us hear from him. Over to you, Manish sir.
Thank you, Pritam. Good afternoon, everybody. Thanks for sparing your time. It's the end of the quarter, and as usual, we have come up with our webinar at the end of each quarter. So, what a tumultuous quarter that we have had, all the last 3 months, thanks to whatever was happening in the Middle East. Very, very problematic as far as India is concerned. But timely action from the RBI as far as the FCNRB announcements were concerned, the rupee has seen some resilience of late, and consequently, we have also seen the FIIs slow their pace of sales in India, because the first half of the calendar year 2026, we have seen some heightened selling. But of late, in the month of June, we have seen that the buying has continued. Ever since the FCNRB announcements, based on expectations of around $50 to $60 billion that we are likely to get till 30th of September, already money has started flowing, or dollars have started flowing into the debt funds. The debt side of inflows from the FIs fund has been seen. And in the month of June, we have also started seeing some inflows into the equity side of things. So, free fall in the market per se, we have tested 22,000 two times. Once at the time of Operation Sindoor in the month of May, June 2025. And again, post the Iran crisis, we have once again seen that 22,000 get defended. Currently, we are closer to around 24,000, 24.2, and the all-time highs was 26.8. So roughly around 10% still away from the Nifty 50 all-time highs. The insight is that the broader markets are doing well in terms of earnings. When we compare the performance of the Nifty 50 earnings, and we compare the performance of Nifty 100 earnings and Nifty 150 Midcap earnings and Nifty 250 NSE 250 Smallcap earnings. Broadly, we are seeing that Nifty earnings growth is less than double digits. For FY26, it's mid-single digit sort of an earnings growth. NSE 500 or BSE 500 is decent, around For the fourth quarter, we have seen earnings growth of around 14%, 5% for Nifty 50, 14% for NSE 500 or BSE 500. We have seen 17% earnings growth for Midcap 150 and around 24% earnings growth for Smallcap. So suffice it to say that the reference benchmark for bullishness or bearishness in Indian markets to be gauged not from Nifty 50. Of course, that's the standard benchmark that one sees through for looking at bearishness or bullishness in India. But if you look at with deeper microscopically, the action is outside the Nifty 50. And there are enough money-making opportunities in the broader markets. And, it was a carnage during the March quarter in terms of the broader markets, but things have come back very, very sharply from April to June quarter. And suffice it to say, it is backed by numbers, backed by earnings, and that is the point that we are trying to make. First of all, on the direction of the markets, I think markets are emphatically bullish. Let me just reiterate, emphatically bullish if you were to take the next 2 years point of view. Of course, you could say that Manish Sonthalia is always bullish. That is true. But I think all the headwinds that we have seen over the last 2 years broadly has got priced in. uh, the geopolitical issues, the oil prices, the slowdown, negative impact of AI in India, so on and so forth, and El Nino to put the icing on the cake, the El Nino effect and all of that we have priced in. Even now, after the timely action of the RBI, we are looking at double-digit earnings growth going into FY27. So, 12 to 13% earnings growth for Nifty 50, par the course in 2027. And we're looking at more than that earnings growth in the mid-cap and the small cap segment of the market. So, emphatically, time to put in money when there is a lot of dilemma, because a lot of money is likely to come when markets on an optical basis beyond NSE 50 will cross that 26,800. But bulk of the action would have happened by now, by that time, because you already seen mid cap index cross all time highs, small cap index is barely some percentage points away from all time highs. The dispersion is quite big, even though optically the numbers on the indexes look near to all time highs or crossing all time highs, but the dispersion, median number of stocks, which is still 5 to 7% below in the small cap index, is more than 50%. Dispersion between the largest and the smallest up move is around 88% or 90% in Nifty 50, around 150% in mid cap, and around 300% in the small cap index. So it is a pick and choose market, but optically things are going to look much better going into FY27 and 28. So one of the major reasons why you are not seeing too much of money come into the stock markets was the gold, bullion, and silver, which were also very, very bullish. That has also cooled off thanks to rising interest rate scenario in the US. That is what is being talked about, that in the fourth quarter of the calendar year, likely seeing a rate increase in the US, and that will impact all asset classes adversely. If that was not to come through, then this will again have some positive impacts on the commodities per se. So all these things have combined into the fact that valuations are at par with long-term averages of around 20-21 times FY27 numbers. Not very expensive. We are looking at something like 1225, 1230 for your FY27 numbers, and we are closer to 24,200. So roughly around 20 times and around 1450, if that be the starting point looking at FY28 numbers. But suffice it to say, it is a pick and choose market. The sectors which are predominantly going to be bullish as far as India is concerned, according to me, and this is not now, but the next 5 years. And the beauty is not identifying the sectors, but the stocks within that, because the entire world knows these themes and the spaces, and they are for real. But the point is, what valuation do you buy them, and what discounting do you give, and how much future that you want to discount today. So these would be your high-end manufacturing, which is high-tech manufacturing or advanced manufacturing, so to speak, which includes your aerospace defense, which includes your deep tech. These would be basically in the limelight. Or you could say that India's energy security has got exposed very, very badly So energy transition is the all-pervasive theme between now and 2030, and whether it be uh, solar, wind, pump hydro, battery energy storage, electric vehicles, transmission, and all that goes into the transmission, power cables and conductors and transformers and GIS switchgear, so on and so forth. They are all going to be in the limelight, and you have to just bet on the companies that you want to bet on in these spaces. The third is basically the AI play. We want to be around 6 gigawatts of data center capacity as against 1.5 gigawatt capacity that we have by 2030. Uh, and that is also 3x. And anything to do with infra build out or physical infra build out in the data center space is likely to be in the limelight. So these are the low hanging themes that you have, but the catch is to find the right stock, because everything is priced in at 70, 80, 90p or 100p. So either you be early in the curve and to identify a new name in these spaces and be the one to lead the market into the up move of the stock price, or basically if some stock price has corrected significantly, then you be a bold heart to buy into them. Because if you really believe the story and the numbers behind that story, then you should have that brave heart to you know take hold of that name when the stock price corrects. So all in all, this is the all pervasive theme. Dark horses will be your consumption, because consumption space has not done well. And in an inflationary environment, obviously the top line growth is going to be healthy, but first quarter you're going to likely see margin compression. But this whole El Nino thing is, to my mind, overblown in the social media, because Central India, West India, and South India, West India, after the recent rainfalls that you've seen, is a very minuscule deficit, around 15% deficit that you've seen. The green belt, which is basically your Punjab, Haryana, and Uttar Pradesh. These are slightly more deficient, but food stock grains are ample within our system, and you again be looking at rains in less than 12 months from now. So, from that perspective, that this El Nino thing is weighing on consumption is not with solid background, and markets will like to overlook that. But one more insight into this is that you know. All the incumbent legacy consumption names, whether it be in the staples or whether it be the consumer discretionary space, it is fraught with disruption, because the legacy incumbent players are so docile that they have really not invested behind building new brands over the last 10 years. So, I mean, when was the last time you heard Hindustan Unilever launch a new brand in the last 10 years? They are still working with the old brands of Lifebuoy and Lux and Dove and Surf Excel and all of that. No new brand launched by all these players. What are they busy doing? Is basically acquiring new age brands. So you are seeing all these D2C brands getting acquired by the legacy players, because they have not invested time and energy and money in building new brands. So the insight is that business life cycles have become very, very short. Previous to 10 years, we always used to think that life cycle of a business in India is close to 40-50 years. That's no longer true. Today, the average life cycle of business, particularly in the consumption space, because the modes of consumption have changed, the way consumption is happening with Gen Z, Millennial, and Gen X are very, very different. The life cycles of businesses have shrunk from 40 to 20 years. And we as minority shareholders broadly will invest in one third of that period. So 20 years basically means that your investing horizon will be 8-10 years. And within that, you have to find the name. So, I would basically be, edging on the side of some degree of, positivity in believing that maybe the legacy consumption companies like Lever and HUL and ITCs of the world will not have volume growths of more than 6-7% for as long as you can see. But on the other hand, challenger brands in the D2C segment or new age brands in the D2C segment will have more than 20-30% growth going into the future. So the point is that when we are investing as minority shareholders and our investing horizon is 8 to 10 years, not forever, then basically 10-year DCF, if you were to look into the next 10 years, then you have to project the next 10 years cash flow. So that is the importance of the 10-year DCF that we want to portray. So on that perspective, I think consumption is a dark horse. Just I moved deeper into the consumption theme. And another theme which looks very, very realistic and coming into the forefront is the logistics space. Government of India is very focused on reducing logistics cost. Logistics as a space has not done well in the last 2 years. They may be coming off a very low base, but logistics also looks pretty promising. And guys who have unit economics and more than average margins would come to the forefront if the valuations are pretty decent. Your regular sectors of IT has seen so much of damage in the last 3 months. I mean, the fall has been roughly 30%, and thanks to disruption, the insight into IT is that it's going to be deflationary, and basically the benefits of AI will need to be passed on to clients. And today you have product companies entering into the services business. So, like Microsoft just announced that they would foray into the IT services part and would be challenging the business of the third party IT services companies, which basically will look at competing with Infosys and TCS, etc. So the whole point is that first of all, top line growth is diminished because previously we used to see TCV, which is total contract value, was spread over lesser number of years. Now the TCVs are spread over larger number of years. So, when companies announce the TCV, it's over 8, 10 years. So obviously, new business that's coming in, of course, bill to book looks very, very great, but that bill to book is spread over larger number of years. That's one. So mid-tier, single digit dollar revenue growth is what we are looking at. And if you were to consider rupee depreciation, yes, you will see rupee depreciation to 3 to 4%. So 10% top line growth in INR terms. But margin deflation is for real. So we are used to seeing Infosys at 25% margins and TCS at 25% margins and Infosys at around 20, 21% margins. In the AI environment, when benefits of AI or automation or large language models is to be passed on to your clients, then where is the margin trajectory going to settle? Whether it's 20% or whether it's 18% or whether it's 15%, nobody knows. But when the markets come to understand that this is the bottommost level on margins has got achieved in the IT space, that would be the bottom for Indian IT as well. Till that point in time, it's a transitionary phase. It's not still very clear how the business models of Indian IT services are going to play out, because now you have challengers, large product companies also entering the IT services companies. And obviously, there were a leakage in terms of business going to GCCs that was already prevalent, but now you also have product companies announce that they would be coming to implement the AI modules. And overall AI piece in the overall turnover of the incumbent companies is still very, very small. So AI transitioning from traditional businesses, application maintenance, development, all those things is likely not going to move the needle. That is why I say that you'll have single-digit sort of a growth in the top line in dollar terms. So yes, it has fallen too much. It may bounce back because today you're pricing in zero growth at 12, 13p or 14p and 5%, 4% free cash flow yields and similar around 3, 4% dividend yields. I mean, it's no longer a case of paying any premium or basically you're discounting growth to the bear share. And, the zero growth business will also have a 15p. So today, in that backdrop, they look like classic value plays, but it may remain a classic value play for some time. But there can be a big bounce to the extent of 20, 30% from here. And, because it has fallen so fast, so soon, and so deep, it will recover. So that is where the positioning on IT is. The story is not yet out as to whether there is a case of long-term investing still prevalent in Indian IT services, unless and until they mend their business model. So that is one. Secondly, the regular BFSI space. Look, the large sector, private sector banks are struggling with leadership issues. All the four, except for let's say Axis Bank, the top three like ICICI Bank only has a 2-year extension for Mr. Sandeep Bakshi. Markets will start worrying about who comes in next. Kotak has seen the CEO and the MD go. So now there's a hunt for a new MD out there, the CEO out there. So that is a problem. And in all likelihood, HDFC Bank is also struggling with issues, a lot of issues. So, these four large private sector banks, if they are headwinded in terms of management issues, then in spite of a very good growth environment as far as the lending side of things are concerned, the credit growth in the system is now crossed around 15-16%. That will help them. And asset quality is absolutely pristine. There's no problems with that. But whether there's a case of a re-rating, I would not know. But definitely, you'll have some helping hand come in, because in a rising interest rate scenario, and let's assume that after a higher touch, Indian markets will also say a rising interest rate scenario, banks will be favored as opposed to NBFCs. In that space, you'll have large private sector banks also go through that tailwind. So that's on the lending side, and on non-lending side, capital markets, etc., are in sweet spot. Not too much of a problem, because over the quarter, the AUM growth would be there, and obviously new issues and NSE IPO and demat accounts uh, will take care of all the players in the capital market space, and they have come off a low base. So that's and NBFCs microfinance is coming up big time, and that's one space again which will have new investment opportunities that we are likely to see. NBFC, affordable housing, gold finance, again pick and choose within that space. So that's basically around 40% of the market, 30%, 32% on the BFSI, and around 8-9% on the tech side. Otherwise, it's a very balanced environment that we are in currently. So that's regarding the direction of the market. I will just like to take you through the portfolio that we have. So this is the SMID portfolio which we are running, and Q4 earnings growth for this portfolio was around 24%, but we had some loss to profit and profit to loss sort of a situation. If we were to exclude those names, then the profit growth for Q4 26 was around 35%. And if you were to look at the next 2 years of growth, next 2 years of growth, we are looking at EPS growth of 27 of around 58%. And this is basically these ex VIP, and these are loss to profit sort of a scenario. Westlife, Max is basically an insurance company. That's we're likely to see. So these are the earnings growth. Average would be of 27 and 28, around 38%, from 26 to 28 on a PEG basis. 27 is just trading at 1.44 PEG, and on an FY28 basis, trading at 1.14. If you were to look at golden decade, the outcome on the earnings, we had 40% earnings growth for FY26 fourth quarter, but this has a element of growth, supernormal growth come in on account of Zomato. Zomato in 25 was a loss number, and this year it was a profit number. So if you were to exclude Zomato, if you were to exclude the loss to profit to loss scenario in IndusInd and the insurance companies, you are seeing the portfolio growth of 20% in the fourth quarter. Full year FY26, the earnings growth was around 11% for the portfolio. And if you were to look at how we are projecting the numbers, it's around 27 EPS growth for cumulative EPS growth of around 40.7% between 26 and 28. And if you were to exclude external and in this end, we are looking at 26 to 28 of around 26%. If you were to look at the PEG of the portfolio trailing, which is the year gone by, looking at 2.6. PEG of 27 is 1.7, and PEG of 28 is 1.17. So one mention out here is that over the last 2 years, we have seen that after April 25, we have seen that the broader markets have struggled. As you know, that the golden decade portfolio has 2/3 mid and small caps. It is basically 1/3 large cap, 1/3 mid cap, and 1/3 small cap. We were slightly headwinded, but since now the broader markets have come back, we have seen that tailwind also come through. So if I was to just show to you the snapshot on the performance side first, let me show to you the gold indicate side. So this is how the performance is since inception. We are beating the benchmark, but it's somewhat volatile that you've seen because two-thirds of the segment in the markets was the mid and the small cap. So on a 2-year basis, we are outperforming. On a 1-year basis, we are also decently outperforming, and since inception also. So it is a function of how the broader markets vis-a-vis the large caps move, because there was some time frame where the large caps and a very skewed large cap actually did very well. That was the point in time we had challenges on performance, but it has come back because the broader markets have performed. If you were to look at the SMID segment, the last 3 months has been very good. As I said, that we have not changed one bit on the portfolio. What the earnings growth on the portfolio, whatever has come through 35% for Q4, and the next 2 years around 38%, not a single change, except for one change. We launched this portfolio on 9th of June, but we saw 100 rupees first become 75 rupees, and this 75 rupees has become 95 rupees 10 paisa today. So it's still down 4.9%. And I said that, the average median stock in the small cap index, 50% of them are down more than 5% even now, even though the index has come back. So as we see more participation of stocks in the small cap space, we are likely to see a tailwind. But some of the stocks which were dormant for the last 2 years was down 35-40% over the last 2 years have started coming back in a big way. So case in point was an Akams drugs, which had fallen 50%, is again come back. So 400 rupees stock price is now 700 rupees today. Or a J&K bank, which had fallen to 97 rupees or 89 rupees, is today around 190 rupees. So there was nothing wrong in the fundamentals. Fundamentals were pretty good. And some of the stocks that were there in the index, in the small cap portfolio also has started contributing. So as we gain strength in terms of the number of stocks that we see above our buying price, that number is comfortably now between 75 and 80% of the stock since inception above our buying price. So whatever balance as they approach across the all-time highs, you're likely seeing performance even since inception across time periods because the back data gets impacted. So we are pretty confident if the numbers and the earnings do come through, then obviously it's only a matter of time. The last 3 months has been pretty decent. So just maintaining conviction on that name. This is how the entire situation looked like for the portfolios that we have. And so I'll just stop here and just open the floor for questions. Thank you.
Thank you so much, sir. It was really an insightful session. It has certainly strengthened my confidence on the markets being bullish for next 2 years. And very specifically, I would say SMID and Golden Decade, which is also the listed side portfolio of Emerging Stars Series 7 EI. I would request participants to please drop your questions in the Q&A box, which we could take them up to Manish sir. In the meanwhile, sir, we could start with a couple of questions that I have. So, I mean, going forward, the first question would be on Wednesday, we learned that Mr. Trump had announced the ceasefire is over and he doesn't want to deal anymore with the Iranians. And we have seen the flare up, Nifty down by 300 points. Obviously, it recovered again till date by 200 points. But what is the impact do you see? I mean, you foresee on the markets over the long term?
No. So Saudi Arabia has announced an $11 discount on Brent. So for Asian buyers, it basically means Brent. And the way to look at it is like this. There will be a lot of to and fro on this Middle East thing. This guy is going to bomb Iran. Iran is going to bomb all the bases in the Middle East. All this drama will go on. The only point that you need to consider, and this is what I think, is that as long as oil is flowing through Strait of Hormuz, and as long as Iran is able to sell oil to its partners, it wouldn't matter too much. So two things. One, oil is flowing. India gets its oil. India gets its LPG. India gets its ammonia and fertilizer. We are fine. So as long as it is not a complete embargo on the Strait of Hormuz, let them drop missiles and bombs on each other. Should not be too much. Trump has already said one day, we'll need to wipe them off, and second day he says, no, we can make a deal. So we are used to, that sort of enigma from his side on a last three-month basis, and we should take it in our stride. So my base case scenario is that this war has ended. there will be pushes and pulls all along. Oil will flow. And today the world is oversupplied in oil because for the first time, IEA, which is International Energy Association, has on an aggregate basis forecasted a lower oil demand for the entire globe this year vis-a-vis last year. So this energy transition is already starting to take effect on fossil fuel. Why do you think Saudi Arabia is saying, pump more oil? I'm going to give $11 more discount, take my oil. All of these things is because there is a conscious reason why the world is moving away from this blackmailing Strait of Hormuz, because it's likely to come back in sometime in the future also. So one needs to diversify the risk. And that's basically how it should be. So no case for a bearishness. In fact, if you have a 2,000 point drop, I would believe it's a buy on dip. And that's why I'm saying emphatically for the next 2 years, be bullish on the market.
Very happy to know that from you, sir. We
No,
have a
but take
yeah,
it with a pinch of salt because I'm more often than not bullish. So not on the bearish side of things, but these are the reasons why I feel more bullish. And I think all the negatives are broadly priced in, and the markets do climb a wall of worry. So we have climbed a wall of worry, and there's no wall that we see at this given point in time. But there will be future walls also. Who knows what? But we'll take that when it comes. But as of now, things looks clear.
understood, sir. We have a question from Mr. Krishna Prasad. He wants to know what is the peg of SMID.
Yeah, I showed it to you.
Yeah,
1.4 and 1.14 on an FY27 and FY28 basis. 1.44 and 1.14. We generally want to buy between 1 and 1.5, at the best 1.8, 1.7, and we would be wary if this whole portfolio peg was to go beyond 3. Because I think
right.
system growth rate of 10%, 30% growth sustainably across the portfolio is difficult. So that is why we look to trim or sell if the peg moves closer to 3.
Understood, sir. So even I would be more interested in knowing about SMID since we have witnessed that 27% of absolute returns in past 3 months. What should investors expect? What should investors expect going ahead? Like,
So 2 or 3 expectations. The index Nifty 50 is behind the curve because the stalwarts have not delivered numbers over the last 5 years. Asian Paints, HUL, ITC, Reliance. So earnings growth for some of these names are less than 10%. And on the other hand, some of the new growth drivers in the business, thanks to these mega impetus that's coming on advanced manufacturing and energy and AI and all these things, they are not represented in the index at all. They are outside the index. So the fun is not in the index; it is outside the index. And it's a pick and choose. So obviously, your SMID has a larger playing space. So that is what I'm trying to say. Of course, your return expectations at all points in time would be that portfolio earnings likely to double in 3 to 4 years, 18 to 24%. And if we are not overpaying, that is to say, if we are buying between 1 and 1.5 PEG, then your portfolio should also double in 3.5 years. You should just keep with that expectation. And I think it's a stock selection market. There's no thematic, etc., that works in a SMID or a micro cap portfolio. It's basically that individual company because this index is 250 stocks and we are playing with 32 stocks or 30 stocks. So, there is a huge active management. It's just betting on that particular stock, whether if it does well, you'll do better than the index. If you not, then you'll trail the index. So that's how it is. But the growth, the earnings is more prevalent in outside the index than index. The index means your BSC 30 or NSC 50. It's staggering more towards the mid, small, and at best NSC 100, which is outside the Nifty 50, which is NSC Nifty 100 minus Nifty 50. There is where the growth is also in the large case. So that is the playing area which is more suited for higher growth and higher returns.
fair enough. Will you prefer holding some cash component considering the current market scenario, or you'll go all out?
I am saying I am hyper bullish. So, when this crisis was going on, I used to tell my clients that keep some dry powder, stagger it in 3 installments. But now that this whole thing is over for all practical purposes, I'm in the camp, no cash, go all in. I'm not
Understood,
holding
sir.
any cash.
Correct.
Clients who have decided for STPs, etc., will happen that way. But if there's a lump sum, I'll deploy for.
So after the recent recovery, how should investors think about allocation between large cap, mid cap, and small cap stocks? Where
So
do you currently see the best risk reward opportunities?
NSC, small cap and micro cap will offer the best opportunity set. Mid caps definition is that this 150 stocks is slightly skewed on more expensive side. You'll have opportunities in Nifty 100 minus Nifty 50, that space, small cap and micro cap space better than the Nifty mid cap space. There is where your maximum allocation should be. So fair bit of allocation in the Nifty small cap, micro cap, which is roughly around, let's say, 30%. 30% Nifty 100 minus Nifty 50, 30%, 35% in basically your micro cap and small cap. Balance you could be having allocation in mid cap.
Fair enough, sir. The upcoming earnings season is just around the corner, sir. What are your expectations from corporate India, and which sectors do you believe could surprise positively for results of quarter one of this FY 26-27? Will India be able to resilient around the margins?
No, that is the problem. Margins are going to be a problem for the first quarter. Full year earnings growth for Nifty 50, if that's the standard gauge, is around 13-14%, but first quarter will be 10%. Earnings growth will be 8 to 10%, not even 10%. 8-9% should be our earnings because top line growth is going to be good. Top line growth is going to be likely 15%, 14-15%. But the margin drag will be there because of high raw material cost, higher cost of capital. So they will impinge on margins, but I don't think there's going to be any massively negative or positive. Whatever is done is likely to play out, will likely play out. So IT is going to be bad. BFSI will be decent numbers. Of course, on a very high base of last year, you'll see a drag in terms of private sector banks, but even public sector bank will be around the 12 to 15% sort of a growth. And the large cap private sector bank will have a 10%. Unless and until there's a turnaround case and so on and so forth. But this is likely to be the case. Automobiles is likely to be headwinded in terms of margins. Top line growth will be around 15, bottom line will be around 10, 50-60% drag on margins. Capital goods is likely to be very strong. Cement is going to be bad. Healthcare is very diversified. Some sectors will do well, some sectors won't do well. But hospitals and these spaces, individual pharma companies like GLP-1s and chronic, these are likely to do pretty decent. CDMO space is likely to do very well. And these have been outperforming the markets of late. So that is one space. Power, data center, these will all do very well on the top line, even in the growth front. The only problem out here is the margin. So not too much of a negative sentiment per se. It's broadly known. That's likely to play out. I think only the dark horse will be consumer names. Consumer names, according to me, will surprise on the positive side. Consumer names are likely to surprise on the positive side on the earnings part. This is one space that one can look out for. And the second is basically your logistics. Because I think the commentary after the DFC has got commissioned and this whole emphasis of shipping PLI of 70,000 crores, logistics is coming off a very low base. So one should look out for even logistics.
Okay, sir. Any changes you're likely to make in the either of the portfolios?
Yeah. So we'll sell some and we'll buy some. A lot of companies identified. We'll have a new name that will be having, in the unlisted space in AR7. So from that point of view, I will. There will be changes in the unlisted and even the listed space. Some of these high flying names. Problem is that the growth is some very good. But what do I do with the valuation? So valuation hygiene. is something to minutely analyze before you take a call, because buying peak growth at peak prices is also damaging. So there should be some nervousness, some circumspect positioning on individual names. That's the best time to enter.
Correct, sir. Just that you mentioned that we have a blended EF which you are managing, which is consisting of 30% of the unlisted pre-IPO space. Where do you see opportunity in that particular unlisted space?
Same space, that is capital goods, power, AI, defense, aerospace, EMS, semiconductor, all these spaces only. These are the high growth spaces. And if you buy them young, you'll have a long tail. Because this theme is going to stay for the next 5 years. There's no doubt about it. And there will be many new names that will come. So earlier you get into these names, better.
Correct, sir. Yes. But on the unlisted side, we would be having 5 to 6 names. Am I correct?
Not necessarily 5 to 6, maybe 3 to 4. 3 to
Okay.
4, because 35%, right? And if I allocate, let's say, 10%, then obviously you are left with only 3.5 names. If full 10% goes in each stock, they will have only 3.5 stocks. So 5 stocks will be on the outer side.
Correct. India is a commodity-driven market. How do you see the commodity segment? Be it bullion.
Commodity will depend a lot on interest rates, global interest rates, the AI bubble bursting or not bursting. That also is a function of Anthropic and ChatGPT. OpenAI basically IPO getting fructified anytime soon, and this whole uh, Middle East thing, supply chain bottlenecks keeping commodities elevated. So supply chain disruption, if it's normalized, then commodities are not going to be very strong till at least the end of September or in the early part of fourth quarter calendar year 26. Today it is a very sideways market. Individual components like aluminium has fallen, copper has not fallen that much, gold and silver has fallen, crude oil has fallen, rare earths is still in demand, excess of demand over supply. All those things. Iron ore is trading at rock bottom prices. Steel is on an upcycle. So a lot of things to consider on the commodity side. But India is a user of commodities more than producer of commodities. So two-thirds of businesses in India will be user of commodity. One-third of business in India will be a producer of commodity. And in that backdrop, a lower commodity price is working to our advantage rather than disadvantage.
Got it, sir. We have a question from Mr. Bhavin Sarada. He wants to know what about FMCG or consumer sector?
That was said. I can literally underwrite in believing that HUL for the rest of its lifetime is not going to see more than 6-7% volume growth. So what I mean to say is FMCG space go for D2C or new or smaller companies, because Gen Z, millennial have no brand loyalty, and the distributor, dealer, retailer model is going defunct in the new age system that we are in, or the platform based businesses, the quick commerce, the e-commerce. This is all disrupting businesses. Challenger brands will find acceptability. Of course, you can't have these brands grow to what HUL size is today. They will be smaller than them, but the growth rates are going to be much faster. So we saw Mama Earth, right? It first struggled and now it's getting its act together. This is one of the challenger brands in the D2C space. Of course, you will have a physical as well as D2C as well as e-commerce. So things are basically going to move in the e-commerce, quick commerce space, which is roughly around 12-13% of the entire top line. This number is going to grow. And incumbent FMCG brands are not investing in new brands. They're sitting on their laurels. That's what example I gave. No, HUL has not launched a new brand in the last 10 years. Name a new brand which they have launched in the last 10 years. If you rest on your laurels when the world is moving around you, you will be at the receiving end. So from that point of view, they will struggle for growth. But new brands, new companies, acquisition candidates, they are the areas to focus on as far as the FMCG space is concerned. But answering your question more in number terms, top line growth is going to be there because we are in an inflationary environment, volume growth plus top line growth. So let's say 6-7% volume growth plus some top line growth. Top line growth is going to be optically very, very good. But what about the margin? Because headwinds into the space, uh, you will be left with problems on the valuation side again. So few companies which are inventing at the margin a Marico or let's say a GCPL, which is more diversified into Indonesia and let's say India, the high growth markets, they will be better placed, and they are introducing new categories like your deodorants and all of that, the air fresheners and the air, all these things where you see top line growth and preservation of the margin will be much better placed. But this will be far and few. You can't apply that for everything.
I hope his answer has been questioned. I'm sorry, his question has been answered. So we have a
Life
question.
cycle, life cycles in businesses have become half. This is the ultimate truth that we must live. When we used to predict valuations 10 years ago, 15 years ago, and how we should look at the longevity of businesses and terminal value, because long only investing involves a lot of terminal value. The assumption on the longevity of growth and the exit multiple and the terminal value has changed significantly.
Correct. So there is a question, the name is not mentioned, but any thoughts of AGI Green Pack, the competitor that went down, the water is coming back. Would that impact the margin?
They have, in fact, gained market share. They are running at full capacity. Pricing power is significant, and import can't happen. Liquor bottles can't be imported, right? So, today you are trading at inexpensive valuations of 10, 12. It's a great buying opportunity. Hindustan National Glass is not coming up anytime soon. 50% of their furnaces requires a lot of investments. So not only are they gaining market share in the specialty glass segment, and mind you, if your major raw material is energy, and your Middle East has disrupted CNG prices and LPG prices, then obviously you are in a much better pricing power scenario in taking price hikes and volume market share from the unorganized players based in and around Faridabad. They will be decimated. And your biggest competitor in terms of operational capacity is just 50% of its nameplate capacity. So all in all, if you have alcohol segment growing and specialty segment in perfumes or FMCG and pharma gaining traction, and you are still 20% of the market share, you are growing your market share. The additional capacity of 500 TPD is going to get commissioned in FY27 second half. How can you have this company at 10, 12 P prices to earning multiple? This just can't figure out.
Understood, sir. We have a question from Mr. Devansh More. He wants to know, there is a lot of hype around silver right now. Everyone seems to be saying it is perfect time to buy both gold and silver. Gold at least has a clear driver, geopolitical tensions, but what will be driving silver? Is there a genuine story behind it, or is it just another market fad?
No, there is a genuine story on AI and electric batteries. Consumption of silver will be there. Of course, there are talks about a new technology in the EV and AI ecosystem. When you talk about physical data center creation, that will substitute copper with silver. Of course, minuscule in terms of percentages. So I would bet on both gold and silver from the next 5 years point of view. Asset allocation is important in this space. Uh, Build 10% of your portfolio in precious metals at all prices, including current, and have the mix of gold to silver at around 60 to 40. That should be fine.
Understood, sir. There is a question from Mr. Krishna Prasad. What do you think of banks, PSU and private, large versus small banks?
It's basically earnings growth and valuations again. So no preferred pick on either PSU or private. Look for that important nuance in that particular bank, which is not yet factored in. So I have bet on, let's say, an IndusInd Bank, which is obviously a large private sector bank, which is down from its all-time highs and it's going through a lot of challenges. So in the banking space, it goes through the same cycle. No bank goes insolvent. I mean, majority of the times. There is a problem, there is a cleanup, there is a refinancing, there is a growth, then that growth gets priced in, and then again there is a mess up that happens, and then again it gets cleaned up. So it goes through a cycle of up and down and up and down. So you buy at a point in time when there is a lot of mess and the mess has got priced in, and there is a tailwind that is building on account of growth, but markets don't realize that growth till at about the point in time the growth actually is visible in the numbers. By that time the stock is already at 40-50%. Except for this, where you have an outlandish opportunity set before you, it's a steady state 10 to 15% sort of a growth across banks on a run rate basis. Today the growth rate in the system is 15%. You should also grow at 12-15% across banks, because the macro environment is prevalent both for the private sector banks and the public sector banks. Deposit problems in terms of CD ratio is there for across the system. But the private sector banks are hard pressed more for deposits in terms of CD ratio than public sector banks. So yeah, that's how it is.
Understood, sir. There is a question from Mr. Bhagirath. He wants to know, how do you see FIs impacting market now onwards?
So it's likely that FIs are likely to come. As I said, this RBI action, timely action on RBI, on the FCNR side, is likely to save the currency. Otherwise, currency was in a free fall. 100 is what we would have seen. Now, by at least we have a lifeline in terms of the currency till September 30th. And if this gets defended to the extent of 93, 94 in the worst case scenario, 91, 92, you will likely see the FIs reversing their course as far as the negativity around India is concerned. This is my base case assumption. Of course, oil must remain within a range of around $60 to $80 per barrel, not that 120 and all of that. And this AI narrative in the US should slightly weaken, which is it's happening. Now people have started questioning the expensiveness of the usage of AI tokens, because it's just prohibitively expensive. So the usage case cannot be taken for granted. It is basically rationing of usage of AI LLMs according to the need is what is now getting priced in. And in that environment, if they were selling because India was not a direct AI play, then anti-AI is likely to be beneficial for India.
Correct. There is a question where the gentleman wants to know, where do you see our AF6 going forward? I mean,
So AI6, if you were to hold for the next full tenor, will meet that 18 to 24% CAGR growth rate. Well, as I said, it was one third large cap, one third mid cap, one third small cap. In the last 1.25 years, the two-third segment of the market was clearly headwinded, where earnings growth was coming, but the valuations were getting deflated. So we believe in numbers, and numbers are basically taken with some degree of certainty, and the valuation is a moving target. It gets underpriced, it gets overpriced. And on ultimate basis, every earnings growth will get priced to perfection. And in the next 3 to 5 years, if the earnings growth is 18 to 24%, your portfolio earnings growth, the portfolio performance will also be 18 to 24%. If you remember correctly, AF6 in the first year had some massive absolute returns and as well as outperformance. But subsequently, the two-thirds segment of the market, which was exposed, and this is by default and design of the mandate of the fund, was in the broader markets, and they corrected. We also corrected, but now it's coming back. So keep your faith, keep your thing. 18 to 24% should get achieved, because the math behind that is what I explained.
correct, sir. There is a question. Is MFI pain behind now? What do
Yes,
you think of small finance bank and NBFCs?
very selective. If you want, I mean, I can talk about the number because it's a closed forum, but some of the known names is where you should bet on. MFI has bottomed. It's coming out on a new cycle. You could bet on a Credac, which is the leader in the MFI space, or an Ujjivan. Uh, and if you want to go in for slightly more riskier ones, because expectation of returns are bigger, you should go in for a Spandana or a Fusion. But microfinance definitely looks interesting at this point.
Okay, sir. We have a question from Mr. Yogesh Kumar. He wants to know your views on global investing for retail investors.
If you want to invest in SpaceX, I mean, I don't have any fundamentals to explain this. It is basically growing with the crowd. But what I can assume is that this AI narrative is was driving the South Korean markets and the Taiwanese markets and the US market. The US market is red hot. One would be advised to avoid the US markets. Till you have clarity, till you have this clarity on the midterm elections and the rate hikes from the Fed Reserve, uh, U.S. markets are best avoided for the time being, and you have this overhang of the pullback that you have seen in the SpaceX IPO price. You know, it went up and then has corrected, and these two guys, Anthropic, OpenAI, are postponing their public issues, and there's correction that also you see in Hynix and Samsung and Taiwanese markets because of the semiconductor RAM issues. So I think India is best suited in these environments, or you could look at some uh, beneficiaries of uh, negative AI. Even commodities are correcting, so even China, from a longer term perspective, yes, but maybe they can also see some time correction. Of course, I'm not a great expert, but what I can under in international markets, but I understand that the US is very, very vulnerable. You know, this is one segment where majority of the investments outside India is flowing through. Take it with a pinch of salt. I am not in the camp who believes that buying US right now is advisable. But I could be wrong because these guys have been going momentum all along in the garb of technology and AI. But I mean, the concentration of the top 10 stocks at more than 40-50% of the market. I mean, just not fathomable that SpaceX and all these companies are trading at $2 trillion, $3 trillion with a minuscule profits. Of course, it's not about today, the next 10 years, but it's just like pie in the sky sort of a situation bereft of fundamentals where I would not be the best.
Understood, sir. I think there are no more questions. I think we can conclude today's session. Thank you so much, Manish sir, for sharing such valuable insights and navigating us the right direction that is much needed in this current market situation. I'm
So
sure along with
I reiterate, be more bullish than bearish in the current circumstances, even though you see negative repercussions, news flows on the global macro front. I don't think take them with a pinch of salt. It is a buy on dips. You take your preferred bet where you want to, but stay positive on it. Thank you so much.
100%, sir. I'm sure along with me, our listeners also, I mean, be it partners or clients, have also gained meaningful takeaways and would be bullish. We truly appreciate your presence and participation. Have a happy evening. Thank you so much.
Thank you. Have a great day.
Thank you so much, sir.